Hi class, today we're going to be looking at chapter 2. I'm going to work a problem with the working with T accounts. So if you bear with me just a minute, I'm going to share my screen with you. You should be able to see problem 2-01B. And what we're going to be doing is we're going to be working with the T accounts that we talked about on the previous video. And we're going to be analyzing transactions through T account. This problem would be similar to your homework problem. First of all, make sure you read all your instructions. It says Ken Jones is an architect and he's opening an office on April the 1st, 2019. So this is a brand new company. During the month, he completes the following transactions connected with his professional practice. All of the transactions are from A to O. And so what I want to do with you is I want to analyze each one of these transactions by first recording it in a T account. So what I need to do is we need to look at transaction A. Transaction A says that transferred cash from a personal bank account to an account to be used for the business. That's $18,000. What I want you to remember is how we put that in the accounting equation from chapter 1. You'll remember that cash was an asset. And when we put asset into our business, our cash account is increasing. So each one of our account classifications has an account that will go with it. The cash account is an asset account. And because it is an asset account, it will be increasing in this situation because the owner made an investment in the company. So when you're recording in a T account, the left side of the account is always the debit side of the account, and the right side of the account is always the credit side of the account. What you have to know is which account you're using. First of all, we're using cash, and you need to know how it is classified. Cash is an asset account. Assets increase on the debit side. So I'm going to record this transaction by putting an A in the slot beside of the debit, which is on the left side of the account. I'm going to put the amount in as $18,000. So anytime you increase cash, you record it on the debit side. The debit side will increase the cash, which is an asset. All assets increase on the left side. That's the side of their increase. So right now, I have cash in my business of $18,000. Remember from last chapter that every transaction has to have at least 2 accounts involved. So the first account that we're recording this in is cash. Notice that cash is increasing on the left-hand side, which is the debit side. So my cash is debited in this case. I need another account to balance out this A transaction. To balance out the A transaction, the other part of this is going to affect the capital account, which is owner's equity. And that is because the owner made an investment in the business. His owner's equity has increased. So I'm going to look for my T account that has capital as its name Right here is my T account. Notice there's a left side and a right side, as there are on all of the T accounts. The left side means the debit side. The right side means the credit side. And this is what you need to know about transaction A. First of all, the owner made an investment, so the capital account will be increasing. To increase capital, we always put it on the credit side. The credit side will increase the capital account. Remember from chapter 1, your accounting equation, assets equal liabilities plus owner's equity. Owner's equity is over on the right-hand side of the accounting equation. And so the right side is going to be the increase side for your capital account. Your capital account transaction, this is the second part of the A transaction, and the amount that the owner invested was $18,000. So every transaction has to have at least 2 accounts. One of my accounts was to cash in this situation where we debited it for $18,000. The other account was to capital, where we credited it for $18,000. Every transaction has to have at least 1 debit and 1 credit in order to balance. My debit was to cash for $18,000. My assets increased by $18,000. Over on the right-hand side of the accounting equation, my owner's equity capital has increased by $18,000. So we're still in balance after this transaction. So for every transaction, you have to have at least 2 accounts involved. You'll remember we called them parts in the last chapter. Now we're changing it to say that every transaction has to have at least 2 parts to it. And now I'm going to add in this chapter that every transaction must have at least 1 debit and 1 credit. My debit was to my cash account for transaction A. My credit was to the capital account for transaction A. Both accounts are $18,000. Both accounts in this situation are increasing. My assets went up by a total of $18,000. My owner's equity went up by a total of $18,000. We are in balance. In the next transaction, B, we are purchasing a used automobile for $19,500. We paid cash down and we gave a note payable for the remainder. This transaction has 3 parts involved. Remember, every transaction has to have at least 2 accounts. This one just happens to have 3 accounts that will be involved. Read your transaction carefully. It gives you important information that lets you know how to analyze this account. And what we're doing by putting transactions into T accounts is we're just analyzing our transactions. Our T accounts are going to be our scrap paper for helping us to analyze transactions. These T accounts are not formal accounting documents, but they will help us just to analyze the transactions. I always recommend that when you are analyzing a transaction, you put it in T accounts first. Then later on, we will copy from our T accounts to the journal, and from the journal to the ledger, and from the ledger to what we call a trial balance. We will be learning how to do that in the remainder of this chapter. What I want you to concentrate on in this problem is just learning how to analyze transactions through your T accounts. So for the B transaction, we're going to purchase a used automobile. What did we buy? We bought an automobile. You have to know what classification an automobile would fit in. An automobile is an example of an asset. So if we buy an asset, we now have an asset that we didn't have before this transaction. We own an automobile now, so we have the right to use it. It meets the definition of an asset. We bought an automobile, so I'm going to hunt for an account that has at the top of it automobiles. Do you see it's right here? Automobiles is an example of an asset. Assets increase on the debit side. The debit side is the left side of the account. So in this transaction, we're going to label it transaction B because this is where it's coming from. And usually we have dates for transactions. So there really should have been a date here, but for some reason or another, Cengage just labeled it transaction B. We'd want to write down the date that we purchased the automobile in the real world. The automobile is an asset account. The asset is increasing in the B transaction. To increase an asset, we would debit it. You always record your asset accounts at what they cost you. This automobile cost us $19,500. So my automobile will be debited for the purchase price of this asset, which was $19,500. Now notice in this B transaction, it says that we paid $2,500 in cash as and this is really a down payment toward that automobile. Anytime you pay your cash out, your cash is decreasing. So I'm going to go to my cash account. I'm going to make my cash, which is an asset, go down. Assets go down on the credit side. So this is coming from the B transaction. I'm going to make my cash go down on the right side, which is the credit side, for $2,500. So I debited my automobile for $19,500. I've got a credit to my cash for $2,500. My accounting equation is not in balance. $19,500 is not $2,500. So what we have to do is we have to find the difference between what we purchased the asset for and the cash that we paid down. We bought the asset at a cost of $19,500. I'm going to subtract out the cash that was paid down of $2,500, and what that tells me is that I still owe $17,000. Notice in the B transaction, it says that you gave a note payable for the remainder. The note payable is a liability. Because we owe $17,000, our liabilities have increased. So I'm going to look for my liability account called notes payable. And my notes payable account will be increasing. To increase the liability, we will credit that account. This came from transaction B. The amount that I owe on this transaction is $17,000. So notice I'm putting it on the credit side of the notes payable. Now just look at the B transaction. I've got a credit to notes payable, and I've got a credit to my cash account for $2,500. The two of these added together equals my debit to my automobile at $19,500. So I know that my transaction is in balance through the accounting equation. I know that my debits total equals my total of my credits. And just because we had three parts to it, one of those was a debit, and we had two credits. The two credits would be added together to get the total credits, which should equal the total debits. You can always check your work just to make sure that you're on the right track. And I would suggest that you do that often, so you'll know that you are recording these transactions properly. On the C transaction, we paid rent for the office and workroom. So we know that when we see the word paid, our cash is decreasing. You have to know that cash is an asset. And because cash is decreasing, we decrease an asset on the credit side. So my C transaction has a credit to cash of $3,150. I must have at least two parts to the transaction. In C, the other part to this transaction was that I paid rent. So I'm going to look for my rent expense account. I'm going to put down that this came from transaction C, and I'm going to record the amount of my rent expense, which according to transaction C was $3,150. Check your work to make sure that everything has been recorded properly. And we're okay with that transaction. So I'm going to move to my D transaction. In my D transaction, it says that I paid cash. Well, if you paid cash, your cash, which is an asset, is decreasing. So for transaction D, I'm going to show my cash going down for $1,450. That's how much I paid for my supplies. I bought supplies. Supplies is an example of a prepaid expense, and supplies is an asset account. All prepaid expenses are treated as assets until they are used. In this transaction, we're buying an asset. So we've got to put it in the supplies account where it belongs. So I'm going to look for my supplies account. I'm going to record that this is transaction D, and the amount that I paid for the supplies was $1,450. Notice I put it on the debit side because my asset supplies is increasing. To increase an asset, you will debit. I have a debit to supplies for $1,450. I have a credit to cash for $1,450. My transaction is in balance. My total debits must equal the total credits. So I want you to write this down, class. All transactions have to have at least two accounts involved. All transactions have to have at least one debit and 1 credit. And all transactions, the total debits must equal the total credits. Every transaction should balance back through the accounting equation that you learned how to do in the last chapter. So I'm going to check my work for transaction D, and I'm going to move to transaction E. In transaction E, it tells us that we have purchased office and computer equipment on account. When we buy office equipment or computer equipment, we're going to put that in an account called office equipment or computer equipment, and that account is an asset account. Notice they just put down equipment here. So I'm going to put down the transaction number, which I can't remember what it was. So I'm going to go back up to the top. It's transaction E that we were working on. So I'm going to choose transaction E. I'm going to put on the debit side of my asset account equipment the amount that I bought the equipment for. The equipment was purchased for $6,500. When you buy equipment, which is an asset, the asset is increasing. To increase an asset, you have to put it on the left side or the debit side of the account. So my equipment has a debit in there. I know that in every transaction, I have to have at least 2 parts or 2 accounts. I need another account, and the other account has to have at least 1 credit associated with it. So read your transaction carefully. Again, we are purchasing office and computer equipment on account. So because we did not pay cash for this equipment in this transaction, because it says we put it on account, that means that we owe it. It's a liability, and we call that accounts payable. So I'm going to look for my accounts payable account. And because accounts payable is a liability, it's going to go up on the credit side because I owe money now. I owe more than I did in the last transaction. I'm going to record it on the credit side. This came from transaction E, and the liabilities have increased by $6,500 in this transaction. Notice I put it on the right side of the account because the credit side increases our liabilities. Our liability account is accounts payable. So check your work. And you can see here that it gave me the green mark, so we can go on to the next transaction. In transaction F, it says that we paid cash. Big hint there, paid cash means cash is going down. To make cash go down, we're going to put it on the right side because assets decrease on the credit side. The okay, let me see where I was here. I was on F. So we're going to choose F for the F transaction. On the credit side, I'm going to put down what we paid out. We paid out $2,400. And I paid for insurance policies, and insurance is a type of a prepaid expense. Insurance is recorded as an asset before you can use it. So we're going to look for an account called prepaid insurance. This is an asset account. My asset accounts are increasing because of transaction F. My asset account is going up by $2,400 because I bought the rights to use the insurance. When I have purchased an asset, I'm going to debit the asset account. The debit side is the left side of the account. I have one debit for transaction F. I have one credit for transaction F. The two equal, so we're in balance. So we're moving to transaction G. In transaction G, it says we have received cash. Well, I know that cash is my account that's going to be affected here, and cash, since I'm receiving it, will be increasing. So I'm going to put my increase to my cash account on the left side, and the amount of that increase was $12,000. So my cash account, which is an asset, has increased by $12,000 because I've received cash. Now you might ask yourself, well, why did I receive that cash? And it tells you you received it from a client for plans that were delivered. The plans that were delivered is your revenue account. In other words, you have worked in this business and you've earned some revenue. The revenue account title is professional fees. So I'm going to label this as transaction G, and I'm going to put down the amount of my revenue, which was $12,000. Notice that I am putting that $12,000 on the right side, which is the credit side of my revenue account. Professional fees is a revenue account. My revenue is increasing by $12,000. It's going up. So my revenue went up on the credit side. My cash went up on the debit side. And so I am equal. So I'm going to check my work. And then we're going to move on to H. In H, we paid cash. So my cash was affected again. Anytime you pay out cash, your cash is decreasing. And anytime cash decreases, you put it on the credit side, which is the right side of the account. My cash is decreasing by $1,800. Ask yourself, why did your cash go down? It went down because I paid a creditor on account. So that means you paid a liability. So in this case, your cash went down, which is on the asset side. Assets are decreasing. But my accounts payable will be decreasing on the debit side, and the accounts payable will decrease by $1,800. To decrease accounts payable, we have to debit it. Check your work. So in H, my cash went down, which was an asset. My liabilities, accounts payable, went down by the amount of $1,800. In I, we paid cash for miscellaneous expenses. Again, I paid out my cash, so my cash is going to be decreasing. It's going to decrease in the amount of $375. Why did your cash decrease? Because you paid out some money for miscellaneous expenses. So I'm going to look for my miscellaneous expense account. And my miscellaneous expense account is increasing. Did you hear me say that the expense is going up? Now, remember that when expenses are going up, we're putting it on the debit side. But the total of my expenses will eventually decrease your owner's equity. All I'm saying here is that my expenses went up right now. To make expenses go up, you got to put them on the debit side. That's the side they increase on, and the amount is $375. And make sure you put in what transaction this was. So class, just bear with me until I can figure out what transaction it was. All right, it was transaction I. So we're going to choose I here. All right, and then I'm going to check my work. I had a debit to my miscellaneous expense, and I credited my cash account for $375. On the next transaction, it tells us that we received an invoice for blueprint service and that it was due in May. Now this one, they tried to trick you. Usually when we see invoices, it means it's some type of accounts receivable, but that's not the case in this transaction because we are receiving the invoice. That means we gotta have to pay a bill. We have received a bill, in other words, for blueprint services. Notice that it's due in May, and this month is April. So even though it's going to be due in May, we have to record it in this month to get our revenues and our expenses matched up properly in the right accounting period. So I have to show that I have incurred an expense for that blueprint service. So my expenses are going to be increasing in this case for the blueprint expense. My expenses will be increasing on the debit side for blueprint expense. And we got to remember what transaction we're on, which was J. We've also got to remember what the amount was that we are going to pay next month, and that was $2,500. My blueprint expense is debited because we are increasing the expense account. Now, we did not pay for this expense. We just are showing that the expense belongs in April. The expense, because it was incurred in April, has to be recorded in April. If the expense has been incurred, if we know about an expense, if we know about it in April, it must be written down in April. So I'm going to write it down as a debit because my expenses are increasing. Now, I did not pay cash for it. It's due next month. Next month, I'm going to pay cash for it. But this month, it's going to be a liability to me. So in my drop-down menu under accounts payable over on the credit side, I'm going to pick up the transaction, which was J. And I'm going to put in the amount of $2,500. Check your work. And you can see that J was okay for the debit and J is okay for the credit. Accounts payable increased on the credit side. My liabilities went up because of that transaction, because we're going to pay it in May, not in April. We're going to pay it in May. I created a liability in J. For K, it says you recorded fees earned. That's a revenue account. Fees earned on plans were delivered. Payment is to be received in May. So what happened was you worked. So you have some revenue that you've earned in April. That revenue has to be recorded in the time period that it's earned in. Since we've earned the revenue in April, we're going to go to our fees earned or our professional fees, and we're going to record that as a credit. This transaction happened on transaction K. We're going to increase our revenue. Our revenue was going to be increased by $15,650. To increase revenue, we would credit. So my professional fees is credited. I have to have a debit that goes with that. That debit is going to be to accounts receivable. The transaction was K. The amount of the debit to accounts receivable is $15,650. Now, why did I put that in accounts receivable? I put it in accounts receivable because it is going to be received in May. This is April. Accounts receivable is an asset account. My accounts receivable is increasing. To increase an asset, we would debit. My professional fees is a revenue account. To increase it, we credited it. So I'm going to check my work and we're going to continue on. I want you to hold on for just a minute. I keep thinking about something and I was wondering if I had done it properly. So I'm going to stop sharing for just a minute and then I'm going to pull it back up again. I'm thinking I'm recording this. I better make sure though, because if I'm not recording it, there's no need to go on. hold on just a minute. I'm going to stop sharing for just a second. Yeah, I am recording it, so that's a good thing. I was worrying for nothing. Sometimes that happens, class. So let me see if I can get back to where I was before. Okay, you should be able to see your screen again. And so I'm going to continue on and stop this worrying stuff. Okay, all right, class. I believe that I was on transaction L. On transaction L, we paid the salary an assistant of $2,800. Anytime you pay out your money, your cash is decreasing. So I'm going to choose L because my cash, which is an asset, is going down. Assets decrease on the credit side. You may have to refer back to your T accounts with classifications on them. What I would suggest you do, class, is you pull out those account classifications and have them in front of you when you are looking at your transactions and analyzing them. So in other words, I would write down the account classifications before I even start a problem, and then try to analyze it by looking at those account classifications in Cengage. I hope that that would be a tip that would help you a little bit. But getting back to I, we paid a salary, so my cash is decreasing by $2,800. To decrease cash, you have to put it on the credit side. The assets are going down. To make an asset go down, you credit it. The cash went down because I paid a salary. My salary expenses are going up. Salary expenses will always be increasing in this chapter. We're going to make them go up in this chapter. Now in chapter 4, we don't do that, but in chapter 2 and 3, our expenses always are increasing. So that's another little tip that might help you. My expenses are going to be increasing by $2,800 for my salary. So I have a debit to salary expense, and I have a credit to my cash account for $2,800. And that's how you would analyze this transaction. In M, you paid cash for miscellaneous expenses. So M, you paid cash of $200. My cash account decreased. To make cash, which is an asset, go down, it has to go down on the credit side. I paid for a miscellaneous expense. My miscellaneous expenses have increased. So my miscellaneous expense is going to increase by the amount that I paid, which was $200, and I believe that was for transaction N. Yes, it was. So I'm going to check my work. And then in N, it says you paid $300 on a note payable. My cash decreased again by $300. I paid it toward a note payable. I paid off part of my liabilities. Make sure you get it in notes payable because that's the correct account. My notes payable, which is a liability, is decreasing for the amount that I paid out, which was $300.